Most people believe wealth is lost because of bad markets, a sudden crash, a recession, bad timing. This belief is comforting because it removes responsibility. Charlie Munger would argue that this explanation is mostly wrong. Markets do not destroy most fortunes. People do. Over decades of observing investors, one pattern appears again and again. Those who lose money are rarely unintelligent. They are not lacking information. They are not incapable of understanding numbers. What they lack is restraint. Making money over a lifetime is not especially difficult. Not making stupid mistakes is far more challenging. Most people assume success comes from brilliance, from finding the next big opportunity, from acting faster than everyone else, but wealth rarely disappears because someone failed to be clever. It disappears because someone failed to control themselves. They chased what was popular instead of what was sensible. They acted when they should have waited. They reacted emotionally to short-term noise, and slowly, almost invisibly, they undermined their own future. The market doesn't need to deceive you. It doesn't need to trick you or target you. It simply waits. It waits for impatience. It waits for fear. It waits for confidence to turn into arrogance. Volatility is not dangerous by itself. Human behavior is. People underestimate how long real success takes, and they overestimate how much action is required. They want fast rewards in a system that pays slowly. They want certainty in a world built on probability. When reality fails to deliver instant results, frustration sets in. And when frustration takes control, discipline disappears. At that point, the damage is already done. Most financial mistakes are not dramatic. They are small, repeated, and completely unnecessary. The investor who survives long-term is not the smartest person in the room. It is the one who understands their own limitations, the one who accepts that emotions are expensive, that urgency is dangerous, and that doing nothing is often the hardest skill to master. If you want wealth to last, the first lesson is not how to win. It is how not to lose. And that lesson begins with an uncomfortable truth. The greatest threat to your financial future has never been the market. It has always been you. The desire to get rich quickly is not a small mistake. It is a structural flaw in thinking. People believe speed equals intelligence. They believe faster gains mean better decisions. Charlie Munger would say this is exactly backwards. Anything that promises fast wealth almost always carries hidden risk, and risk does not disappear just because you don't see it yet. Markets reward patience. They punish urgency. But most people cannot tolerate slow progress. They want results now. They want confirmation quickly, so they chase what is rising. They abandon what feels boring. They confuse movement with progress. This is not investing. This is gambling with a spreadsheet. Compounding does not announce itself. It does not feel exciting in early years. It feels insignificant. That is why most people abandon it before it has time to work. They underestimate time. They overestimate their own ability to outsmart probability. Charlie Munger often pointed out that envy plays a larger role than logic. Seeing others get rich faster creates pressure. Pressure creates impatience. Impatience leads to bad decisions. People do not fail because they chose the wrong stock once. They fail because they repeatedly demand unrealistic outcomes. They expect high returns with low risk. They expect certainty in an uncertain system. They expect short-term rewards from long-term processes. The market does not operate that way. It never has. Wealth is not built through dramatic moments. It is built through long periods of consistency. The problem is that consistency feels unimpressive. It does not produce stories worth bragging about. It does not generate excitement at dinner tables. But it quietly works. The urge to get rich quickly is really the urge to skip discomfort, to skip waiting, to skip discipline. And skipping those steps almost always leads to regret. Charlie Munger understood that survival matters more than speed. If you avoid catastrophic mistakes, time becomes your ally. If you chase speed, time becomes your enemy. In investing, slow is not a weakness. Slow is a filter. It removes impatience. It removes impulsive behavior. It removes people who are never meant to stay in the game. Those who remain are not the smartest. They are the most realistic. They understand that getting rich slowly is the fastest, reliable path that actually exists. One of the most expensive mistakes an investor can make is believing they already know enough. Charlie Munger never believed intelligence was a fixed asset. He believed it was something that had to be maintained. The world does not stop changing because you feel confident. Business models evolve. Incentives shift. Risks move to places you are no longer watching. When learning stops, understanding slowly decays. This is what makes the mistake so dangerous. It does not feel like failure. It feels like comfort. Experience creates confidence. Confidence, when unchecked, turns into complacency. And complacency is silent. Investors who stop learning do not suddenly become reckless. They simply rely on outdated assumptions. They repeat strategies that once worked. They mistake familiarity for insight. Over time, their decisions get worse while their confidence remains high. This is how people lose money without realizing why. Charlie Munger believed that learning should be continuous because reality is continuous. If your mental models are old, you are solving new problems with expired tools. The market does not punish ignorance immediately. It allows it to persist for a while. That delay is what makes the lesson so expensive. Many investors confuse reading headlines with learning. They consume information but never update their thinking. They collect opinions instead of understanding systems. Learning is not about volume. It is about refinement. It is about removing bad ideas, sharpening useful ones, and admitting when something no longer applies. This requires humility, and humility is rare once success arrives. Charlie Munger often warned that the biggest danger comes after you have done reasonably well. That is when people stop questioning themselves. That is when curiosity fades. That is when decline quietly begins. Long-term success demands a commitment to lifelong learning. Not because knowledge guarantees profits, but because ignorance guarantees mistakes. The investor who survives is not the one who knows everything. It is the one who keeps updating what they know. In investing, stopping learning is not standing still. It is moving backward while believing you are still ahead. Most investors believe their problem is information. They think better data will lead to better outcomes. Charlie Munger understood something far more important. The biggest investment mistakes are not intellectual. They are emotional. Markets move constantly. Prices rise. Prices fall. None of this is personal, but people react as if it is. Fear convinces investors that danger is permanent. Greed convinces them that opportunity will last forever. Both are illusions. When prices fall, fear demands action. When prices rise, greed demands participation. In both cases, Emotion pushes people to act exactly when restraint is required. Charlie Munger often pointed out that emotions are not just feelings, they are forces that distort judgment. Fear narrows thinking. Greed shortens time horizons. Pride prevents people from admitting mistakes. Together, they form a perfect recipe for bad decisions. The market does not reward constant activity. It rewards correct inactivity. But doing nothing feels uncomfortable. It feels irresponsible. It feels like missing out. So people trade, they adjust, they interfere, and with every emotional decision, they add friction to a system that already works against impatience. Volatility is unavoidable. Emotional reaction is optional. Yet most investors confuse volatility with risk. They treat price movement as danger instead of understanding it as normal behavior. Charlie Munger believed that temperament was more important than IQ. The ability to stay calm when others are panicking. The ability to wait when others are rushing. This is not a personality trait. It is a discipline that must be built deliberately. Emotional control does not mean ignoring reality. It means responding to reality rationally. It means accepting uncertainty without demanding immediate resolution. Investors who fail emotionally rarely fail all at once. They fail through a series of small reactions. A little fear here, a little greed there. Over time, those reactions compound, just like returns, but in the wrong direction. Charlie Munger understood that markets are designed to test patience and self-control. Those who master their emotions do not eliminate risk. They eliminate unnecessary mistakes, and that alone creates a massive long-term advantage. Charlie Munger was never interested in appearing brilliant. He was interested in not being foolish. This idea sounds modest. It is not. Most people believe success comes from making smart moves, from finding clever strategies, from discovering something others missed. Munger believed this mindset was deeply flawed. He understood that life and investing are more often ruined by obvious mistakes than saved by rare moments of genius. That is why he focused on inversion. Instead of asking how to succeed, he asked how people fail, and then he avoided those behaviors relentlessly. People fail by being impatient, by being emotional, by being overconfident, by believing they are exceptions to basic rules. None of this requires low intelligence. In fact, high intelligence can make it worse. Smart people are better at rationalizing bad decisions. They can build elegant explanations for actions that should never have been taken. Munger often warned that intelligence without discipline is a dangerous combination. Avoiding stupidity is not passive. It requires constant self-awareness. It means recognizing situations where incentives are misaligned, where emotions are running high, where the odds are quietly stacked against you, and then stepping away. Most people do the opposite. They move closer to complexity, closer to excitement, closer to situations where mistakes are likely. They assume complexity signals opportunity. Munger assumed it signaled danger. He preferred simple ideas executed consistently over long periods of time, not because simple ideas are easy, but because they reduce the chance of catastrophic error. One major mistake can erase decades of discipline. Avoiding stupidity is a form of protection. It keeps compounding alive. You do not need extraordinary returns if you avoid extraordinary losses. This is where Munger's thinking becomes uncomfortable, because it suggests that many failures were never necessary. They were not caused by bad luck. They were caused by ignoring obvious risks, by acting when patience was required, by speaking when silence was wiser, by doing something when doing nothing would have been better. Munger believed that long-term success comes from building a system that makes foolish behavior difficult, not a system that relies on constant brilliance. In the end, the advantage is simple. People who avoid stupidity stay in the game longer, and in investing, time is the most powerful advantage there is. Most people assume Charlie Munger's ideas only apply to professionals, to people with access, connections, or special insight. That assumption is wrong. His approach was designed specifically for imperfect humans operating in an uncertain world. You do not need complex strategies to apply this thinking. You need fewer decisions, better filters, and stronger rules. The first rule is simple. Avoid what you do not understand. Confusion is not a temporary inconvenience. It is a warning signal. If you cannot explain an investment clearly, you are not early. You are exposed. The second rule is to resist trends. Popularity is rarely aligned with value. By the time something feels obvious, most of the advantage is already gone. Munger believed that chasing trends is just another form of emotional decision-making. The third rule is to design systems that protect you from yourself. Do not rely on willpower. It fails under stress. Build structures that make bad behavior difficult. Automatic investing, long-term time horizons, fewer opportunities to interfere. The goal is not constant optimization. It is long-term survival. Munger understood that consistency beats intensity. Doing reasonable things for a very long time outperforms heroic efforts that cannot be sustained. Another key principle is accepting boredom. Good investing is repetitive, predictable, unexciting. If your strategy needs constant stimulation, it will eventually demand constant action, and constant action increases the chance of error. Munger never tried to predict short-term outcomes. He focused on positioning himself so that time worked in his favor. That is something anyone can do. You do not need to forecast markets. You need to avoid behaviors that destroy compounding, excessive trading, overconfidence, emotional reactions to noise. The most effective strategy is often the one that allows you to do less while staying consistent. Munger's thinking does not promise excitement. It promises durability. It is not designed to impress others. It is designed to work quietly over decades. For ordinary investors, this is not a limitation. It is a massive advantage. Charlie Munger never believed wealth was proof of intelligence. He believed it was evidence of temperament. Over a lifetime, markets test more than your ideas. They test your patience, your humility, your ability to sit still when others are restless. Short-term success can come from luck. Long-term wealth cannot. It requires a personality that does not self-destruct under pressure. Most people focus on returns. Munger focused on survival, because survival allows time to do the heavy lifting, and time, when paired with discipline, solves problems that intelligence cannot. Lasting wealth is not built through constant action. It is built through consistent behavior, through saying no more often than yes, through avoiding situations where emotions are likely to take control, through accepting that progress will often feel slower than expected. Munger understood that you do not need to outperform everyone. You only need to avoid catastrophic mistakes. You do not need to predict the future. You need to remain rational while the future unfolds. This is why wealth tends to move quietly toward certain types of people. Those who are patient when others rush. Those who are disciplined when others improvise. Those who continue learning when others settle into comfort. In the end, money follows behavior. It follows people who respect probability, who understand their own weaknesses, who design their lives to reduce the chance of foolish decisions. Charlie Munger once said that the best way to get ahead is to avoid being a fool. It sounds simple. It is not easy, but it works. You do not need a dramatic breakthrough. You do not need extraordinary brilliance. If you can avoid the obvious mistakes, if you can remain patient, if you can let time work without interference, wealth does not need to be chased. It will stay.